Welcome to Civics Vanguard. Ever wondered how banks work and why they're so important to the global economy? You've definitely heard of banks, but what are they really? They're not just buildings with vaults and ATMs. Banks are financial hubs where over $17 trillion in deposits move around in the US alone. They take your money, lend it out, and somehow, everyone ends up richer. Well, kinda. So why do banks even exist in the first place? Simply put, banks connect people who have money with those who need it. They help you save, grow your wealth, and get loans to make big things happen, like buying a house or starting a business. In fact, over 70% of people globally rely on banks for these services. So, where do banks actually get their money from? Well, it's not from magic. Banks primarily rely on deposits from customers like you and me, but it doesn't stop there. Banks also borrow from each other and from the central bank. In fact, over 60% of bank funding comes from deposits alone. So yeah, your savings are crucial. You're probably wondering, how do banks make money if they're just holding our cash? Well, it's all about lending. They lend your deposits to others and charge interest on those loans. Banks also make money through fees, credit card interest, and investment activities. In 2020 alone, US banks made over $200 billion just from interest on loans. So, what's the fuel that powers a bank? Deposits. When you put your money in a savings or checking account, the bank uses that cash to lend to others. In fact, about 90% of bank funding comes from deposits. So yeah, your savings are pretty important. Without deposits, banks couldn't do much, and the whole financial system would grind to a halt. Alright, now let's talk about the engine that drives the bank. Loans. Banks take the money you deposit and lend it out to others, charging them interest in return. This is how banks make most of their money. In fact, over 60% of bank revenue comes from loans. So, every time you take out a loan, the bank's engine is running, making them money and fueling the economy. Ever wonder how interest rates work? Here's the deal. Interest rates are the extra money you pay when you borrow from a bank, or the extra you earn when you save. Banks set these rates based on things like inflation and the economy. For example, in 2023, the average mortgage rate in the US was around 6.5%. The higher the rate, the more the bank makes from loans, and the more you pay in interest. Ever heard of fractional reserve banking? It sounds complicated, but it's actually pretty cool. Banks only need to keep a small fraction of your deposit, around 10%, and reserve the rest. They lend it out to others, creating more money in the system. This magic means that for every $1 you deposit, banks can create up to $10 in loans. So, how do banks really create money? It's through something called credit creation. When banks approve a loan, they don't just give away cash, they create it by adding numbers to an account. This means that when you borrow money, the bank creates new funds out of thin air. In fact, over 90% of money in the modern economy is created this way, all thanks to banks. Ever wondered what happens behind the scenes when you apply for a loan? First, the bank checks your credit score, income, and other factors to see if you're a good risk. If everything checks out, they approve the loan, and boom, you've got money. Banks approve over $3 trillion in loans each year just in the US, fueling everything from homes to businesses. Bank accounts aren't just for saving, they're the heart of your financial life. From checking accounts for everyday transactions to savings accounts that earn you interest, they all serve different purposes. In fact, over 90% of Americans have at least one bank account. Your bank account lets you manage money, pay bills, and even get paid, all with just a few clicks. Digital banking and fintech are changing the game. Now, you can do almost everything online, check balances, transfer money, even apply for loans, without stepping foot in a branch. In fact, over 70% of people use mobile banking these days, and fintech companies are growing fast. Banks are going digital, making banking easier, faster, and more accessible for everyone. So, what's the deal with central banks and commercial banks? While commercial banks, like the one where you keep your money, focus on individual customers and businesses, central banks manage the country's money supply. The Federal Reserve in the US is an example of a central bank, controlling things like interest rates and inflation. They work together, but central banks keep the economy stable, while commercial banks handle your day-to-day needs. Banks are highly regulated to keep your money safe. Governments set strict rules to make sure banks don't take too many risks and that your deposits are protected. For example, in the US, the FDIC insures deposits up to $250,000, so even if a bank fails, your money is safe. These safety nets keep the whole banking system stable and trustworthy. What happens if a bank fails? It's not as scary as it sounds. When a bank fails, the government steps in to protect depositors, usually through a bailout or insurance. For example, in 2008, the US government spent over $700 billion to stabilize the financial system. Banks can fail, but your money is usually safe, thanks to regulations and protection systems like FDIC. Ever wonder how money moves across countries? That's where systems like SWIFT and IBAN come in. SWIFT is the global network that banks use to send international payments, while IBAN helps identify your bank account in foreign transactions. Every year, over $150 trillion flows through the SWIFT network. These systems make sure your money gets where it needs to go, no matter the country. Banks are super important for the economy. Without them, things would grind to a halt. They lend money to businesses to grow, people to buy homes, and governments to fund projects. In fact, banks contribute over 10% to global GDP, helping fuel growth and create jobs. So when banks do well, the economy does well, and vice versa. Banks aren't always the good guys. They've had their share of scandals, from the 2008 financial crisis to hidden fees and risky investments. Banks have been at the center of major controversies, but the truth is, banking is a double-edged sword. While it helps grow economies, it can also lead to inequality and corruption. That's why ethical banking and transparency are more important than ever in today's world. The future of banking is looking wild. Think artificial intelligence, crypto, and digital currencies. AI is already helping banks analyze data and make smarter decisions, while cryptocurrencies like Bitcoin are shaking up how we think about money. In fact, over 300 million people globally are using digital currencies right now. The next few years could totally transform how we bank, making everything faster, smarter, and more secure. So, why should you care about how banks work? Because banks impact everything: your savings, loans, investments, and even the global economy. Understanding the basics can help you make smarter financial choices and spot opportunities. In the end, the better you know how banks work, the better you can manage your money and make it work for you. Understanding how banks work is key to making smarter financial decisions. Stay informed, manage your money wisely, and make banking work for you.